We are living in a world where most people can't invest in the companies that they use and love the most. I first had this thought in 2014. I was leaving my Airbnb to get into my Uber to go across town to a meeting I had in a WeWork. I had a bunch of Slack messages, I took a Snapchat up the side of the road, and I was about to set my DraftKings lineup when it hit me. I can't invest in any of these companies because every single one of these companies was private. And I started thinking that investing is hard as it is. It's complicated, it can be overwhelming, and it sometimes just feels like everybody else knows what they're doing and has some secret except for you, right? And so my grandfather used to tell me, it's not that hard to be a great investor. Just go through the course of your ordinary life and invest in the companies that you use and love the most. Well, here I am in my daily life, unable to invest in Slack, Snapchat, DraftKings, you name it, because they're all private. And so I went back to my office frustrated and I made this slide back in 2014. No room for you, but really no room for me, no room for us. Because when a company's private, you have to be what's called an accredited investor to participate. That means you have to be one of the wealthiest 5 to 10% of US households to qualify. But being wealthy isn't sufficient. It's necessary, but not sufficient. You also have to have access. You have to be let into these deals. You have to be in the right rooms in Silicon Valley, Boston, New York. You have to know the venture firms, the angel groups, or the entrepreneurs themselves in order to get into these opportunities. And so there was no room for us. There was no way for me to do that. But somebody must be, right? And so I started digging. And I found this article from around the same time, Meet the Uber Rich. It chronicles dozens of investors who had the opportunity to invest in Uber in its first or second round and had turned that investment opportunity into hundreds of millions of dollars, if not billions by this point. See, Uber in 2014 was already a $17 billion company. It had done millions of rides and had thousands of drivers. And yet none of us, the people who are using, appreciating, and understanding the value that this company and this innovation is providing, were able to invest. So that struck me as problematic. And if we could have invested here in 2014, we still could have tripled our money, assuming reasonable dilution, but we couldn't invest yet because we have to wait for what's called an IPO, an initial public offering, right? The IPO is a critical moment in time because it moves the wealth that's being generated by these innovative companies from the private markets to the public markets. So from a place where it's concentrated and consolidated with those who already have wealth and already have access, to a place where it has the opportunity to be shared by all. And so if you invested in Uber the first day you were legally allowed to, by the way, 5 years after this, so 2019, you would have lost money relatively quickly. You would have lost a third of your money within the first 7 months, and still to this day, you would have yet to recoup your initial investment in Uber. So that struck me as even more problematic, right? And I thought back to this advice that I had from my grandfather, invest in what you know, invest in what you know. I'm thinking, well, this doesn't seem to work for me, but it must have worked for him, right? It must have, or else he wouldn't have told me this. And it turns out it did. So this graph demonstrates innovative companies since the 80s and how that's changed over time. The gray bars in these graphs represent how much wealth was generated by these innovative companies while in the public markets, so where the opportunity is to be shared by all. And the orange demonstrates how much of this wealth was generated in the private markets, where it's concentrated and consolidated with those who already have wealth and already have access. And as you can see, the evolution is astounding. Slowly but surely, until completely, the wealth has shifted from the public markets to the private markets. And if you had invested in Apple in 1980 at their IPO, and you rode this gray graph all the way to the top, you could have turned $1,000 into approximately $1.7 million. That's real wealth. That matters. And you compare that to the Uber example of investing at the IPO, and you can see the stark contrast. So what's happening here? Why have we shifted wealth from a place where it has the opportunity to be shared by all to a place where it's not? Well, in the wake of financial crises, we have a hard problem. We have a dilemma. Because we want to protect investors from making the same mistakes over and over again. We don't want to repeat our past. And so we implement rules and changes to try to accomplish that goal. And in the wake of the dot-com bubble burst in 2000, so right where this graph starts to shift, we made a lot of changes. Starting with Reg FD, fair disclosure in 2000, Sarbanes-Oxley in 2004, Dodd-Frank in 2010, just to name a few. And the unintended consequences of these rule changes is that it made it much more difficult, much more costly, and much more burdensome for a company to go public and to maintain being a publicly reporting business. And so companies' mindsets changed. All of a sudden, instead of wanting to go public, instead of that being part of the American dream, we now had to go public. We were forced to go public and put up with the burden when we wanted access to enormous amounts of capital. I'm talking hundreds of millions, billions of dollars in capital. That's when we had to go public. So the public markets looked around and said, okay, well, why don't we just solve this problem, right? Let's just consolidate our wealth into larger and larger funds, private equity funds, venture funds, you name it, and solve this problem that the companies are having. And so that's what they did. And Uber had a landmark investment in 2016. They raised $3.5 billion from one investor, the likes of which had never been seen. And then WeWork took it a step further. Between 2017 and their eventual IPO in 2021, WeWork raised at least $18.5 billion, all while remaining private. And so what we've done here is we've made it so that companies, they no longer want to go public because it's complicated, costly, burdensome. They don't have to go public anymore because they can just raise billions of dollars while staying private. So why would they go public at all? Well, the answer is because there's still one very important value that the public markets provide, and that's liquidity, cashing out, right? And so when I was growing up and I heard a company was IPOing, I would get excited. Ooh, now I can buy. Now I can finally buy. I can invest in this company that I love, that I've been using, that I appreciate, that I really care about and support. But now that I'm in the world of the financial markets, I understand that IPO has the exact opposite meaning to those that are wealthy and well-connected and in the markets. IPO, that means I can finally sell. That means I can finally sell. So why is it that when the wealthiest and most connected of us are getting excited to sell is the same moment in time that the rest of us are getting excited to buy? That is a problem. And the subject of this talk is investment opportunity matters and how to close the wealth gap. We know we have a wealth gap. We know it's growing, in fact, dramatically over the last 20 years. We know it's larger in the United States than in any of our nation's peers. Any of the G7 nations, we have the largest wealth gap. And yet we all look around being like, how did this happen, right? How do we fix this? Well, this is one of the reasons why it's happening. Because we've reallocated billions of dollars of wealth from the public markets where it used to be shared by all, or at least have the opportunity to be shared by all, to a place where it can only be shared amongst those that already have wealth. Think back to I'm trying to illustrate this point with the Uber example, right? And I outlined 3 doors. The first was if you invested right when the company was getting started, and you could have become a billionaire in door 1. And door 2, if you invested in 2014 when we were first having these thoughts, you still could have tripled your money, assuming reasonable dilution. And in door 3 at the IPO, you lost 1/3 of your money within 7 months. And the point there isn't the results, because investing is risky. Never invest more than you can afford to lose, and recognize that you can lose at any door, especially the earlier you go. But what matters is that we didn't even have the choice. We didn't even have the opportunity to open door 1. We didn't have the opportunity to open door 2. We were only given the opportunity at door 3. And so we've changed the public markets from what was once this beautiful engine that allowed and enabled all of us to participate in the wealth generation from the innovation in this country. And we've turned it into just a tool that those who have already generated the wealth and captured the wealth in the private markets are using to cash out. And I know that sounds bleak, but the good news is we actually have a solution to this problem. We actually have a solution, and it's called the Jobs Act. The Jumpstart Our Business Startups Act, passed with bipartisan support. And what the Jobs Act has done is it's outlined a new way for private companies to interact with investors under new security exemptions. Under these new rules, companies can do 2 things that they never were able to do before while private. Number 1, non-accredited investors can participate. That's the 90 to 95% of us that don't qualify as accredited investors because of wealth standards. Number two, we made it so that private companies can generally solicit for the sale of securities. It's a fancy word for advertisement. You can use the power of the internet to tell the world that you're raising capital and to accept investments via the internet. And so think back again to me from my Airbnb to WeWork in my Uber taking Snapchats, right? I had two barriers. Number one, I wasn't accredited. Well, the Jobs Act solves that problem, just like that. Number two, I didn't have access. Well, the Jobs Act theoretically solves that problem. But here's the real point. Just because there's this new door doesn't mean anybody's going to open it. Just because there's a path doesn't mean anybody's going to walk down it. And so it's on us, the companies of today and tomorrow, to leverage these new rules and to honor our social responsibility to invite our consumers and our community to invest alongside us on our path to growth. And it's on us as consumers to demand that of the companies that we use and that we love the most. Demand that they let us invest with them and support them and be economically incentivized by their growth. And it's on us as investors to think critically about our investment decisions and to invest in things that we think matter, that we think are solving real problems in the real world that can help real people. And it's on all of us to recognize and remember the symbiotic relationship between company, consumer, and investor that has driven economic growth and wealth generation and innovation in this country for centuries. And if we can do that, we have a chance to getting back to our roots as a country of fueling innovation and wealth generation together instead of continuing to fuel the growing wealth gap. Thank you very much.